While everyone debates whether this market rotation signals a new bull phase or distribution top, they're missing what actually drives these patterns. Human psychology creates exploitable inefficiencies, and this week delivered a textbook example of how predictable behavior generates systematic opportunity. The market just experienced something fascinating. After 3 years of double-digit gains concentrated in mega-cap technology, participants finally exhausted their conviction in consensus trades. The Russell 2000 outperformed for 9 straight sessions, matching the longest streak since 1990. Meanwhile, the Magnificent Seven declined, while over 300 S&P companies rose. This isn't random market noise, it's human nature expressing itself through price action. Here's what happened at the psychological level. Fear manifested not as panic selling, but as tactical repositioning. When JP Morgan beat earnings yet dropped over 4%, investors revealed their demand for perfection at current valuations. Taiwan Semiconductor rallied on Capex guidance because forward-looking investment signals matter more than backward-looking results. The crowd processed granular details with precision, rewarding execution and punishing guidance misses. Political uncertainty around Fed independence created reflexive selling that reversed intraday. The DOJ probe into Powell functioned as a volatility injection rather than a structural threat. Participants tested the downside, found buyers, and resumed risk-taking. This behavior signals confidence in underlying economic resilience despite headline turbulence. The inflation data confirmed stickiness without triggering alarm. Core CPI at 2.6% and PPI coming in flat allowed the market to maintain its soft landing framework. Weak payrolls but strong jobless claims created interpretive flexibility, letting both bulls and bears claim validation. The crowd prefers ambiguity to certainty when certainty implies constraint. Now here's how these psychological patterns created systematic opportunities. Equal-weighted indices outperforming market cap-weighted indices signaled breadth expansion, a technical condition that historically extends bull markets rather than terminates them. The 9-day Russell outperformance streak reflected systematic reallocation from crowded growth positions into neglected value pockets. Sector leadership shifted decisively toward energy, materials, and industrials, each posting roughly 6% gains with over half their constituents at 4-week highs. Exxon hit all-time highs while oil prices fell, revealing equity investors priced in margin expansion rather than commodity beta. This decoupling indicates sophisticated sector analysis, not crude momentum chasing. The bond market provided critical context. 10-year yields rising to 4.23%, while equities consolidated, showed the market's acceptance of higher-for-longer rates without triggering risk-off behavior. The 2-year yield at 3.47% priced in Fed pause through mid-year. This yield curve configuration supported financial sector outperformance as net interest margin compression fears abated. Volatility remained suppressed despite headline noise, with compartmentalized risk assessment isolating idiosyncratic threats rather than extrapolating systemic contagion. Geopolitical developments in Iran and Greenland produced intraday swings but failed to sustain directional momentum. Markets have learned to discount Trump-era policy volatility by waiting for implementation details rather than reacting to announcements. The Stoic approach recognizes this rotation represents mechanical rebalancing, not fundamental regime change. Price is the ultimate arbiter of value, and when consensus positions become overcrowded, the system self-corrects through reallocation. Extremes in relative performance create their own countervailing forces as value investors deploy capital and momentum traders rotate. This is exploitable because streaks end not from fundamental deterioration, but because the marginal buyer exhausts and the marginal seller emerges. The current breadth expansion supports continuation rather than reversal. Markets that recover quickly from headline shocks possess momentum that transcends narrative, as demonstrated by the intraday reversal after the Powell news. The disciplined response focuses on process over prediction. Earnings season demands attention to guidance revisions and management tone rather than headline numbers since markets price the future. Sector rotation into cyclicals reflects tactical reallocation rather than strategic repositioning. Energy stocks rallying while oil falls indicates operational efficiency pricing, not commodity exposure. Second-level thinking means recognizing that volatility is the price of admission, not a signal to exit. The system rewards those who avoid recency bias and maintain process discipline during transitions. Rotations create opportunity for those who understand that human psychology drives predictable patterns, and predictable patterns create systematic edge. If you value objective systems over emotional market noise and want to build true psychological edge in your trading, subscribe now. Download the complete Stoic Exploiter framework from the link below. It's the systematic approach to turning human predictability into consistent advantage.